Warren Buffett is arguably the greatest investor to ever live. He has a track record of 20% plus annual returns going back decades. There's simply nobody else who's been that successful for that long. Would you like to know exactly what Buffett is doing with his money today during this pandemic? Want some insight into what the all-time best investor is thinking right now? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Warren Buffett is a personal hero of mine. I've read his biography, The Snowball, twice. At almost 1,000 pages, it's not a quick read. But by following many of his tenets on life and investing, I went from below broke at age 27 to financially free at 33. Buffett's wisdom changed my entire life. Much of that wisdom is, of course, based around how to successfully invest for the long term. I learned that Buffett loves high-quality companies with durable competitive advantages, and he loves stocks that pay growing dividends which he can pile up and reinvest as he sees fit. That's basically how you build a snowball. You invest capital into high-quality businesses, collect those growing dividends, reinvest, and then watch your wealth and passive income snowball right in front of you. So what's the greatest snowball roller of all time doing right now during this pandemic? I just wrote a 5,000-word special report that goes over all the stock trades that Warren Buffett made in the first quarter for the $180 billion stock portfolio he manages within Berkshire Hathaway. You can access that special report in the description box below. I want to discuss one major theme today that describes what Buffett is doing with his capital and stocks and what that might mean for your investments. If I could sum up Buffett's first quarter of 2020 in one word, it would be liquidity. While Buffett has been long known as an eternal optimist who likes to be greedy when others are fearful, he's been notably hesitant to put much capital to work throughout this health crisis. In fact, he was mostly paring back positions and raising capital throughout the first quarter of this year, which includes that massive drop in late March. Furthermore, we also know that in the second quarter of 2020, he sold out of all of the airline holdings that Berkshire Hathaway had, realizing big losses and raising billions more in cash. Since Berkshire Hathaway came into 2020 with well over $100 billion in cash already, I think a lot of people are surprised about this. But I think it's important to keep a number of things in mind here. First, Buffett's usual ability to scoop up sweetheart deals by leveraging his capital and reputation has been greatly diminished by the fact that the Federal Reserve has stepped in with trillions of dollars to support the markets and economy. Buffett can't get the cheap warrants and huge preferred dividends that he was able to get during the financial crisis. Second, Berkshire Hathaway has immense exposure to insurance and reinsurance. It remains to be seen how much of a financial impact the company will have from the pandemic, but it's clear that Buffett is preparing for all possible outcomes. Related to this, Berkshire Hathaway's stock portfolio is heavily tilted toward financials, which puts them on the aggressive end of the risk spectrum. Banks are basically in the eye of the storm right now. Third, Buffett is almost 90 years old. If I were 89 years old with a legendary legacy already intact, I'd be thinking more about taking it easy and riding into the sunset. He's not in wealth building mode anymore. In addition, Todd Combs and Ted Weschler, each of whom manage a large portion of capital for Berkshire Hathaway, are likely to continue taking on larger investment roles as time goes on. It wouldn't surprise me if Buffett were increasingly deferring portfolio decisions to them so that Berkshire Hathaway is better prepared for Buffett's eventual passing. Fourth, Buffett has been clear that he believes it will take a long time for things to recover. Indeed, he spent a great deal of time at this year's Berkshire Hathaway annual meeting discussing how long it took for America to recover from the Great Depression. He clearly sees no need to rush. Fifth, he's on the record about looking for one last elephant, which is what he calls a large business deal. Instead of buying up common stock, Buffett would rather put billions to work all in one shot on an entire business outright. Berkshire Hathaway's 2016 acquisition of Precision Cast Parts for $36 billion, which is the last large acquisition Buffett has authorized, is a perfect example of the kind of elephant he might be hunting for. So what can we mere mortal retail investors take away from all of this? Well, I think it does make sense to be cautious right now. There's no telling how this health crisis will play out. There's no playbook for it in modern history. I think it will be quite a while before the US economy gets back to where it was in January 2020. But that doesn't mean you need to sit on a big pile of cash. Unless you're 89 years old and running major insurance operations worth billions of dollars, you probably don't need to be as cautious as Buffett. With all of the high quality stocks out there priced 20%, 30%, 40%, or 50% less than they were just a few months ago, I would be looking at this correction as an opportunity to buy even more shares for the same amount of money. That doesn't necessarily mean you need to get aggressive though. If you were putting away, say, $1,000 per month into stocks as part of your long-term plan, you might want to stick with that. It's just that $1,000 now buys a lot more stock today than it did a few months ago due to the lower prices. Personally, I'm investing the same amount of monthly money today as I was 6 months ago. I haven't changed anything. I'm sticking to my long-term capital allocation plan. On one hand, I'm super excited to get high-quality dividend aristocrats for much less money than before. This means the same amount of money buys more shares and more dividends than before, which supercharges compounding and gets that snowball even bigger, faster. On the other hand, I'm also keenly aware that we could be dealing with the fallout of this situation for years to come. This isn't the time to put all of your chips on the table and double down on stocks. But I also do not think it's the time to cower in fear and stock up on cash that's slowly losing its value to inflation. Waiting until the all clear signal is given means it might be too late. A rosy outlook usually comes with high prices. The hardest time to invest is almost always the best time to invest. Cautious optimism has worked for hundreds of years. America's exceptionalism has worked for hundreds of years. I don't see any of that changing. We will get past this. If you still have employment and a source of income, and your overall financial position is solid, I'd be cautiously optimistic and slowly putting capital to work in high-quality stocks that you're confident in. Stick to the businesses that have the wherewithal to survive the present and thrive over the long run. And if the market drops more, that's a chance to lock in even lower valuations and higher yields. Buffett already built a snowball worth billions of dollars. He doesn't have anything left to prove. But if you're still rolling your snowball along and trying to achieve financial independence in your life, I'd be seeing this current situation as an opportunity to gather more snow than I'd otherwise be able to. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did. Please also make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, be sure to check the description box below for some important links and additional information, including that massive special report on Warren Buffett that I just put together. I'll see you next time.